here today with Matthew Reed from Edison, and we're going to be talking about Fidelity European Values plc. Now, Europe and its difficulties have been well documented. Is now a good time to be investing in an investment trust with a European focus?
Now, as we discussed in our most recent investment trust quarterly report, Europe has had its fair share of difficulties during the last couple of years. So February 2012 saw the phrase Grexit coined, which obviously looked at the prospect of a Greek exit from the euro. And this looked increasingly likely over the subsequent months. The spotlight then shifted to other highly indebted countries. Now, against this weak economic backdrop, you might expect that equity markets performance would be both poor and volatile. Now, volatility has indeed been a feature of the last couple of years, but actually look at the last 12 months. Whilst European equities were weak in the spring, they've actually rallied during the summer months and actually provided decent performance during 2012. Now, is it a good time to invest? Well, there's considerable debate about this, but if I take Sam Morse, manager of Fidelity European Values, he takes the view that actually, on a 3 to 5 year view, European equity valuations are now currently quite appealing.
What's the trust's investment objective and how is that structured?
Fidelity European Values aims to provide capital growth from investing in a portfolio of continental European equities. Now, it's the largest trust in the sector. It's got assets of circa £730 million. It pays one dividend annually, and all revenue earnings are paid out in full. Now, its capital structure is quite simple. It has one class of share, which is traded on the LSE, so it makes it readily accessible. It can also gear up to about 30% of net assets. At the moment, it's about 13% geared, which is actually probably at the upper end of its typical range.
What style of investment management is used and how does the investment process work?
The investment process, in terms of stock selection, is resolutely bottom-up. The manager is looking for companies that can sustainably grow their dividend over the next 3 to 5 years. Fidelity has an in-house team of circa 40 analysts, and the manager draws heavily on their expertise, but they're looking for companies that will be in structural growth areas, have decent corporate governance, use capital well. What is perhaps a little different about this trust is that there's a top-down overlay in that the manager will look to get the sector allocations broadly within plus 5% of the benchmark, but then actually manage risk within the sectors themselves.
And has the approach been successful?
Well, the trust has outperformed its benchmark index, the FTSE World Eurobex UK, over 1, 3, 5 and 10 years, and the 10-year performance is particularly strong. So if you'd put £100 in the index 10 years ago, you'd have about £245 now. If you put £100 in Fidelity European Values 10 years ago, you'd have £345. And obviously, that said, there has been some volatility. The trust was defensively positioned going into the financial crisis, so it lagged the market rally from about March 2009. That said, it has pretty much recovered most of that lost performance, and this has been despite actually maintaining a defensive stance.
Now, Fidelity European Values is currently trading at a circa 10% discount. How is the board managing that discount?
Now, the trust has an active share repurchase policy aimed at reducing share price volatility. Now, there isn't a formal discount target, but the current circa 10% discount is a little below its 3-year average of 13%, broadly in line with its 5-year average of 5%, which hopefully gives investors some confidence they'll be able to enter and exit the trust at discounts at around these levels.
Thank you very much, Matthew. And if you'd like any more information, please do visit the Edison website.